Good afternoon, good morning, good evening, wherever you are in the world, wherever you're watching this online webinar. My name is Mark McAllister. I am Senior Partner for Holborn, based down here in sunny South Africa, in Cape Town. Today's presentation is to help guide you through the subject of topping up your national insurance contributions from abroad, something that we encourage expats to consider, and there is a deadline associated with what we're about to discuss today. So it's important that you take on board what we're about to discuss, and if there are any questions, we'll do our best to handle those as we go. So here's the subject, or the format, sorry, of the presentation today. We're going to go through what is a UK pension, different types of UK pension, how do you check your national insurance forecast, how you then top up those national insurance contributions, NICS, from abroad, and then just a little bit of a visitation on taxation for UK pensions. This will have predominantly a South African flavour to it because of where I'm based, but if you are based in another jurisdiction, don't hesitate to reach out to us and we'll do our best to talk you through how those different situations work around the world. Part of what we offer here at Holborn is a free pension MOT. So if you have an existing UK pension structure, sorry, or potentially another type of pension in another jurisdiction, perhaps in Gibraltar or Malta or somewhere similar, then please don't hesitate to reach out to us and we'll do our best to assist you after this session. There is a Q&A button at the bottom of the screen if you joined us on Zoom, so don't hesitate to ask questions along the way as they come to mind. I'll do my best to answer them all together at the end. So, a little bit about us. Who are Holborn? Well, we've been around for over 25 years now. We manage about nearly 3 billion of assets under management administration. We've got clients in over 30 different countries and offices in more than 11 jurisdictions, including South Africa, where I'm based. We've got over 2,000 happy client reviews on Trustpilot, so feel free to go and check us out there. The key point of today's message, though, is that the expat deadline is nigh. What do I mean by that? Well, 5th of April 2025 is just around the corner. If you do not pay HMRC for outstanding national insurance contributions, you will not be able to contribute beyond the 6-year period, and thus that could shut off a load of years that would therefore get you to a full pension entitlement a lot sooner. Remember, it takes weeks to get an answer from HMRC. So if you're watching this and you haven't already actioned all of the things we're about to go through today, this is really your last call to action. Even if you act today, it's possible you may not get a response in time. And the indications from HMRC is that this deadline won't be moving. Did move back to this date, it's unlikely to move again. This looks pretty set in stone now. So let me get started with a little bit of an overview. What is a UK pension? Well, a pension is a tax-efficient vehicle designed to help grow and protect your savings to provide for your retirement. You're encouraged to do so through tax incentives so that you aren't a burden on the state. They're normally tax relief going in, but then taxed on the way out. Some pensions provide a pot of cash that you can use at a certain age. Others provide a regular income through your retirement. One of the things that a lot of people aren't aware of that are in South Africa and in certain other jurisdictions as well is that you can potentially get that income when you retire here tax-free. And we'll talk about that later on. So whilst you're in the UK, it's likely you will have paid national insurance contributions whilst you're working. This will result in a potential entitlement to a UK state pension, but only if you have enough qualifying years. You may also likely have paid into a private or workplace pension scheme, and after your property, statistically, that's likely to be your second biggest asset. Did you know that there's an estimated £19 billion in unclaimed pension pots? So, first question is your UK pension pot missing in action? Have you potentially got funds languishing somewhere that you could have access to? Well, that's where our pension tracing service comes in as part of the free pension MOT service. And ultimately, that's where we can help you. So if you're not sure, don't hesitate to reach out to us and we'll do our best to assist you there as well. So what are the main types of UK-based pension? Well, the first one that we're going to spend a lot of time talking about today is the UK state pension provided by His Majesty's now government. There's also defined contributions and defined benefits. We're not going to spend a huge amount of time on those today, but there are other resources on our channels dedicated to just those issues. So let's talk through the state pension. The basic state pension is payable to men before born before, the 6th of April 1951, and to women born before the 6th of April 1953. The maximum amount payable is £156.20 a week, and that was in the year ending April 2024. The new state pension, which is a lot of people that will be on this call will be entitled to, is for men born on or after 6th of April 1951, and to women born on or after the 6th of April 1953. The maximum amount payable is £203.85 a week, and that again is up until April 2024, though this will rise obviously going into 2025. Regardless, a full new state pension requires 35 qualifying years of national insurance payments. If you don't make all those payments, a smaller pro rata pension is paid if you have fewer qualifying years. People who are contracted out might have paid lower NI contributions and receive a lower state pension as well. That's worth being aware of. If you want to find out your current national insurance record, and therefore what you potentially might be entitled to, this is the website you really need to start with. So it's www.gov.uk/check-state-pension. It's a great resource that's free from the government that will answer most, if not all, of your questions. So first things first, let's talk through how you do it. This is a really easy way to do it. I understand that not everyone is technically savvy, and that you might want to just pick up a phone or you might want to just write to someone, but time is of the essence. Like I said, the deadline is fast approaching, so really this is the only option that you can follow and be fairly certain you might get an answer in time before the deadline closes. So once you've gone to that website, you can check your state pension forecast. There's a link there to do it, but to do that, you have to have a government gateway ID number. So if you haven't got one already, you'll need to register for one. Once you're logged in, you will see your current state pension entitlement and the dates associated with it. So it gives you the forecast of how much that's likely to be as it stands at the moment. One of the things, though, that it will point out is whether you have full entitlement. So basically the bottom green bar is saying the maximum that I could get in this situation is £203.85 a week. However, at the moment, I'd only be entitled to £109.62 because I've got some missing years as a result of my move to South Africa. So it's saying that for me to get a full state pension, I need to contribute for 17 more years. But that will include some of the missing years that we're going to talk about in a minute. Moving on. Right, so once you check your UK national insurance record, it will tell you exactly how many years. So at the time that I pulled this through onto the presentation, 18 years of full contribution. I've got 26 years left before when I'm supposed to retire. And it's highlighting that there's 8 years currently where I did not contribute enough, and those are the years that potentially I would need to top up. And you can see it here, it's really clear, showing what years are not full, and surprisingly that's when I've been in South Africa. I'm going to just show you the manual process so that you're aware of that. I would really recommend that you don't follow this process now with the time frame that's left. I don't think you'll get a response in time, so it's good to be aware of it, but I think the time for this has passed, but I'll go through it anyway. So to do so, you can download this BR19 form. There's a pretty long web address there that you can copy, or just Google BR19 state pension forecast form. And once you've downloaded that, you can post that in. Okay. Once you've ascertained what it is that you think you might owe, or where the gaps may be as far as HMRC are concerned, then we get to the subject of actually paying in to recontribute those missing years. So this is the meat of this presentation, really. There's some great resources here from HMRC. You can go online to the web address there and learn about everything I'm talking about today, and hopefully it should echo what you can read on that website. So once you have that forecast, you can pay the shortfall. Now, you don't need to fund the Class 3 version. However, and this is the key bit that's changed since the last time we did this webinar, HMRC are now very much active in telling you whether you can pay Class 2 or Class 3, depending on your employment history. And I've got some examples of the letters that they send back so you can see that as well. So they are allowed, but HMRC have to approve that you are, you can pay the Class 2, the lower Class 2 costs. Why is it so important to try and pay that low amount? Well, it's a significant difference. If you are eligible for Class 2 national insurance contributions, the current cost is up to £179.40, depending on what year it is that you're missing. A full Class 3 contribution is £907.40, so that's a significant cost difference between the two, and it's why we've been encouraging for the last few years around making sure that you do this exercise before it's too late. For every year that you buy back, it equates to about an extra £7 a year in your pension for life. Obviously, that is a moving feast, but it just gives you a bit of a rough idea of what it is that you're actually, quote marks, buying back from the government. From April 2025, it will only be possible to retrospectively purchase the previous 6 UK tax years, so up to about 2020, 2021, and obviously each year that will move forward. So that's why this deadline is so important. If you've been out of the UK for a long time and you need to backdate a lot of years, you might suddenly find that you're going to miss a lot of that, and you might not be able to contribute enough years depending on when it is that you hit the retirement age. So that's why we're really underlining this 5th of April 2025 date, and that, to be clear, is the date that you need to be paying the amount to HMRC. That's not the date that you need to have requested information. It really is, that you need to have solidified what you're doing and paid the money across to HMRC. After that, there's potentially penalties and, like I say, restricting the amount of years that you can do. So if you have gaps before 2016, you need to hurry. You're running out of time. Okay, once you decide to top up the national insurance contributions from abroad, one of the things that you can do is fill in this CF83 form and get that back to HMRC ASAP. So this is the bit that really, if you haven't started already, you really need to get going on urgently and send that into HMRC. So just all you have to do is Google CF83 form, download that, fill that in with your information, get it in the post to them ASAP. You need to send it to the following address, so PT Operations in the northeast of England, HM Revenue and Customs BX9 1AN. United Kingdom. If you've got any problems, there is a line that you can call, and this is the phone number now. They're open between 8 AM and 6 PM UK time, Monday to Friday, and they will be able to guide you, but they're probably going to guide you back to what I'm already telling you. So if you haven't already registered online, got your government gateway ID number, made sure that you know what your missing national insurance contributions are, then sent in the CF83 form, they're probably going to refer you to that in the first instance. From what we can see so far, they are posting back the responses to everyone. So obviously, if you're in a country like South Africa where post doesn't arrive in a quick and timely manner, you might want to nominate somebody that you trust in the UK and post your response back there. Obviously, that's a choice for you to make, depending on whereabouts in the world you are living. Okay, so let's now just touch on the taxation of UK pensions, and particularly that point I mentioned earlier on for South African residents. Actually, sorry, before I do that, I've just realised that I wanted to just show you the forms that have come through that sort of gives you an idea of what to expect. So hopefully you can see this all right. I'm just going to zoom in on it. It's a redacted one, just for those watching from a GDPR perspective. So once your CF83 form has been correctly received by HMRC, you're either going to receive back a letter like this, or you're going to receive a letter with good news saying that you can pay Class 2 contributions. So if we take this example here, it talks through, your qualifying years. So in this case, that individual has 16 qualifying years. And if we scroll on down, it shows where's the shortfall, okay? So going back to 2017 in this case, 2018 and onwards, the amount of weeks and the contribution, how much would need to be paid, and also payment date without penalty is the 5th of April 2025 for all of those years. And then the final time limit shows you the last time that you would be able to pay into those for that respective year. So it is a moving date. So if this individual didn't pay anything at all by April 2025, they wouldn't be able to pay for the missing 2017-2018 tax year. So that's an example of the deadline. We don't know exactly what the penalty is going to be if you don't make a full payment for all the years that they say. That's something that isn't communicated out or available online as far as we can see, but it is something to be aware of when you're deciding how many years you want to pay and the amount. So that's an example of a Class 3 response. So if you get that, then unfortunately, sorry, you're going to be paying the higher rate unless you challenge it with HMRC. And my general guidance with anything to do with revenue authorities around the world, is pay first, challenge, and then get money back from them rather than missing this rather important deadline. But the choice is yours, and you should take advice from your tax consultants. Okay, what I'm going to show you now, though, is the one that you really are hoping for, which is the Class 2 contributions there. So here we can see, that the application to pay national insurance contributions has been approved, and that they've decided you can pay Class 2 NIC contributions whilst abroad. What they then do, however, they don't give you the full confirmation of the numbers to be paid. There's another letter that comes along with this, which then basically you have to fill in to confirm everything before they will finally agree to the numbers that are involved. So unfortunately, this has changed from the last webinar that we did, where it would appear that the onus was on the individuals to choose. Whereas now it seems like HMRC are very clearly now saying they will make the decision based on the information that's provided. So obviously, best of luck trying to get the Class 2 contribution amount. But if not, you might get a Class 3 letter coming back. I hope that all makes sense. Okay, moving back on now to the presentation. So let's talk a little bit about taxation on the UK pension. So typically speaking, when you were working in the UK, these would have been tax-free going in, regardless of whether you're retired abroad or not. That's how the system works. It's encouraging you to be a responsible saver, to plan for the future so that you aren't a burden on the state. So you get a tax incentive on the way in. Typically speaking, you'll be taxed at some level when the funds come out, depending on the amount, and that's normally done at income tax rates in the UK if you were to retire in the UK, which most people do, right? They live and work in the UK and they often retire there. If you considered picking up your pension and moving it abroad to what's called a qualifying recognised overseas pension scheme, that now attracts a 25% exit tax. So quite often that isn't an avenue that we follow for expat clients anymore. It still exists, it still works in some cases, but particularly in South Africa, it's not something that we often follow these days. One of the things that is fantastic about South Africa as a jurisdiction, and in some other jurisdictions as well, is that if you leave it in the UK, you can draw that benefit in retirement with what's called treaty relief, effectively at a 0% income tax rate in South Africa. Yeah, what a pleasure. However, you do need to go through a process to achieve that. Otherwise, the pension provider who uses basically a payroll system, a PAYE system, will pay you as though you're a UK tax resident and deduct tax accordingly. That's normally what happens. So that's where we come in. We often make sure that whatever you have in place is set up correctly, so that you are able to take advantage of that when you come to enjoy your retirement abroad. So if in doubt, reach out to us. It's also worth noting on the subject of taxation on UK pensions, there is a change on the horizon in 2027 around UK inheritance tax. It is in the last budget. So all we can do is say that it is there, and that's when they say that they're going to make that change. And what that means is that in the future, your UK pension will be calculated as part of your UK inheritance calculation when you pass away. So this is more of a specialist area of advice. I'm not going to go into it hugely today, but if you have a pension that's worth, say, more than the inheritance tax limit of £325,000, or you've got other assets in the UK like a property or cash or anything like that, it might be worthwhile speaking to our team or a tax consultant in your jurisdiction just to get an idea of what your inheritance tax liability might be and how that might impact your loved ones in 2027 and beyond, and whether there's some restructuring that might be worth considering. That's all I can say at this time on that. Okay, again, focusing on South Africa, one of the great things about living here is that there is a binding general ruling. This goes back to 2017, and it's very, very clear about the tax rules, and it exempts from income tax foreign pensions as long as they were accrued whilst working outside of the Republic. So effectively what that means is when you take the income, you can be paid without paying UK tax, but also effectively without South African income tax. So not only do you get a fantastic quality of life here in South Africa at a lower cost with people that speak English and drive on the correct side of the road, but you can also do it at a much lower tax bracket than you potentially would be in the UK. What a pleasure. So I'm not just here to extol the virtues of South Africa. It's worth bearing in mind that this might also apply in other jurisdictions as well, so just bear it in mind. If you're one of the lucky clients that have a private workplace pension in the UK, it might make sense to go through one of our free pension MOTs where we look under the bonnet and make sure that what you have in place still works for you. Reason being, many UK providers don't want clients who move overseas. They'll do things like insist on postal communications. They may not want to take the risk with managing you. They might even offboard you. We had this instance actually with a client with an ISA with, I think it was Santander, that just because they moved to South Africa, they closed her ISA, and we managed to step in and find an alternative provider. So what I'm saying is that there is those risks and really complications associated with moving abroad. So perhaps one of the options to consider is an alternative that is designed for expats, still based in the UK as a solution, a very cost-effective solution, but with UK expats in mind. And we use these kind of solutions extensively, so those kind of irritations and problems are removed. What you're able to do as well is consolidate a number of pots into one pot for ease of administration. And the way I explain it, it's kind of like swapping a red folder for a blue folder. It's, you still have the exact same structure in the UK from a pension perspective, but we make sure that it works for you as an expat, depending on where you are around the world. The key thing from a South African perspective is we'll also work with you on the pension treaty relief. We have providers that do that with us, so that you're able to claim that income, like I say, tax-free in South Africa. Why pay unnecessary taxation when a lot of our clients don't have to, and we can guide you through all that process. So where do we start on that process? Well, free pension MOT. So look under the bonnet for those that know what an MOT is. So we start off with a few questions that you should ask yourself, really. So if you've got a private workplace pension of any kind in the UK, do you know who your pension is with? Quite often, one of the things you see is pension providers sell books of business to each other, and you might be with Standard Life 1 minute, and then Scottish Widows the next, and then Aegon the next week. And as a result, you can often lose touch, and that's where these £19 billion worth of pension pots come about. So do you know who your pension is with today? Do you know how much it's worth today? Do you have the ability to draw a statement immediately, without having to ring up a call center or log into a portal? Um, do you know what it's actually invested in? Do you know the individual companies that you're investing in? Do they align with your beliefs and and morals, or are you just in some generic fund that you don't really know what it's invested in? Do you know how much the pandemic impacted on its value? So did it go down a lot? Has it stayed down? Has it maybe popped back up the other side? Do you know what the underlying assets inside that vehicle are doing for you? This is probably the most important question. How is it performing against its peer group? So have you got an engine that's maybe limping along, or is it a V8 petrol engine, or is it a 1 litre diesel engine? Those are the kind of analogies I use. So if in doubt, the MOT that we do will allow you to see what it's doing compared with its peer group. Most importantly of all, though, what will it be worth in the future? What can you realistically plan for to have as a pot of capital or an ongoing income stream in your retirement? We deal with these structures all day, every day. So we try and do our very best to take something that's relatively complicated and explain it to you in very simple to understand, easy English. And lastly, I mean, it does happen, it's very rare, but part of this is a free pension reconnection service. So, if you might not know whether you have a pension at all from when you worked in the UK, we do sometimes reconnect people with pensions that they didn't even know they had. So, like I say, you might be one of those lucky £19 billion worth of unclaimed pension pots. So let's try and get your money back in your control and that you can access it. So it's a very simple form that we use. It's a letter of authority. Doesn't allow us to change anything. We literally are able to have a quick look, like I say, under the bonnet. Once we've satisfied that we have all the information that you'll need, we come back to you with a report. It's a very simple to read report. We try and do everything on like a red, amber, green approach. So you can see where there are concerns that you need to urgently address if there are any. Amber is things that you might want to address, but you don't have to. And green is actually we think it's great and leave it where it is. And quite often that's the advice that we do on these assessments is leave it in place with the provider that you've got on average about 40% of the time. But ultimately the decision is yours. We start off with that as a service that is free of charge. Okay, well, I know that's a lot to take in, but hopefully, we've answered a lot of the questions in relation to today's webinar. I know it's been focused very much on the state pension. If you're unsure of anything, don't hesitate to reach out to myself and my team. You can do that via email. You can do that via WhatsApp on the number that's on screen now, and we'll do our very best to assist you wherever you are. Okay, I think we've got some questions now. So what I'm going to do is I'm going to just bring up the questions and we'll see whether we can answer them as best we can. Okay, so if I'm living in South Africa and I have a UK pension, how do I ensure I'm not taxed on it in South Africa or in the UK? So the treaty relief process is what we're talking about there. So it's a bit of paperwork that involves liaising with SARS, the revenue down here, and HMRC. It doesn't happen overnight. But it's something we do all day, every day in conjunction with our specialist tax consultancies that do this service for us. But likewise, what often happens is that we start off with that pension MOT, look at what you have in place first, and actually pair the two together. So why not create a solution that has all of this put in place from the beginning? Ultimately, the decision is yours, but we can guide you through that. So if that helps, then please don't hesitate to reach out to us and we can maybe guide you through it a bit more. Okay, next question. Again, when you say someone who has contracted out may receive a smaller pension, what do you mean when you mention contracted out? So this is something that historically there was an option to opt out of the state pension historically. And so that depends really on what kind of pension arrangements that you put in place within your employer at the time. If in doubt, though, what determines your state pension is what HMRC on that say on that portal. So to a certain extent, I would part that other bit and just focus on going through the process online with HMRC, so that you know what it is that you have as an entitlement as per your national insurance contributions. And then you'll see whether it's a missing year or not. So rather than, because it's quite a specific question, rather than assume, I would always say check, double check, and make sure, and then from there, then you know where you stand, and do so urgently, because if the year that you're talking about was prior to, I think, 2016, then it's possible that you might not even be able to contribute to top it up, if that money doesn't land with HMRC by early April. So hopefully that answers your question. Really, the summary from me is, to act urgently before it's too late. And if you need help, don't hesitate to contact my team, and I will try and guide you through as best you can. But this webinar has gone through most of what it is that you need to do. So hopefully the answers here will help you free of charge. Ladies and gentlemen, I hope that's been worthwhile. If there's no more questions, we'll wrap it up there for today. I hope it's been of use. I hope that you all are able to get your forms and statements, etc., sorted out in the rundown to the deadline. Please don't leave it any longer. If you haven't acted on it, act today. Next week is probably going to be too late to start this process. So this really is the final call to action. I'll just share my contact details one more time, so that they're there in case you want to reach out. Ladies and gentlemen, again, thank you so much for taking the time to watch this presentation. I hope it helps, and best of luck with contributing to your missing national insurance contributions. Take care.